Roger Montgomery from Montgomery Investments. Thanks for joining us, Roger.
Always a pleasure, mate. Nice to be with you again.
Yeah, likewise.
Thanks for coming to our office.
That's a pleasure as well. So now, a couple of years ago, we were talking about the property market, Australian property market, and the feature of that was that it was an amber light just about to turn red with Australian residential property.
Yeah.
We're well and truly past the red light now.
Yeah.
Are we at the bottom? Where are we at with Australian property?
So the thesis that we had is playing out exactly as we expected. Anyone who bought when we first started warning people not to buy, and that was the end of 15, the start of 16, are now, many of them are now underwater, depending on the type of property and the location of that property. If it's got water views in Sydney, you're probably still doing okay. But if there's nothing unique, there's no unique features about your apartment, it's just like thousands of others, then yeah, you're in trouble. And if you've geared up, you're in more trouble. Yeah. So what's happened now is that we've seen three things occur. Number one, as expected, we saw interest-only loans just stop being written by banks. Now, originally that was because APRA had imposed a cap, but what actually happened is, as a consequence of the Royal Commission, not necessarily the Financial System Inquiry, but as a consequence of the Royal Commission, the banks have just decided to comply. Consequently, they're writing a lot less business. They're taking a lot longer to approve an interest-only loan. They're not lending as much. So what we've seen in the APRA data is that in the quarter ending May 2017, about $36 billion worth of loans were being written, or $33 billion of loans were being written. Fast forward to the September quarter last year, that had dropped to $14 billion. So you saw a 55% decline in interest only. And then as we record this video, APRA hasn't released the December quarter data yet, but that's just a matter of days, and I suspect that'll be lower again. So you're looking at a 55 to 65% decline in investors borrowing money interest only, because typically they're investor loans, to buy property. Yeah. If you pull a rug out you pull that one group of buyers out, or you greatly diminish their ability to spend on property prices aren't going to go up. So that's only one group though. Yeah. If you look at the international buyers, so if we look at Foreign Investment Review Board approvals for the purchase of established and new housing, in 2015-16, that number was $72 billion. In 16-17, that dropped to $25 billion, and in 17-18, that was 12.
Wow, that's a massive reduction.
Yeah, so you've gone from 72 billion to 12 billion.
And that would be largely on the eastern seaboard, would it not? That'd be Melbourne, Sydney,
probably,
pretty much.
Probably. Not uniquely, not just that, but mostly. So now we've pulled from the property market two rugs out from under it. Number one, domestic investors. Number two, foreign buyers. And by the way, that foreign buyer, the deserting or the evaporation of the foreign buyer is global. Everyone's saying that, whether it's Auckland or Toronto or Vancouver or, the New York, London, you name it. Yep. So it's not unique to Australia, it's a global. That's why you've got to look for its source to be global, for it to change. And at the moment, the source was Chinese money, which, they've put a severe limit on the amount of money that can come out of China. So that's two. Number three, new home buyers. This is a loose proxy for new home buyers, and I know that you can get new home buyer loan data, but what I want to do is just look at new houses. So if you look at new houses, so they're houses that Metricon and AV Jennings and Villa World, those sort of homes, well, they're collectively selling a lot less. In fact, the monthly data shows that they're now selling collectively per month about 4,500 homes a month. But if you go back to 2004, that was about 16,000 a month. So we've seen a significant drop in that number, and there was another spike around 2007, 2008, and it's dropped off again. So that suggests that there are fewer first home buyers, there are fewer international buyers, and there are fewer investors. The property market can't go up in those circumstances. The January home loan data shows that January home loans in Australia, all types of home loans, are now down 25% from their peak. Yeah. And it's accelerating. Yeah. The decline is accelerating. So, and that's, by the way, that's first home buyers, new home buyers, investors, all loans are down. Again, no reason to believe that's going to change anytime soon, so property prices will probably continue falling. The consequences of this are quite significant because it's not just the property market that's affected. Obviously, the property market is affected directly, and if you're only building 4,000 new homes a month instead of 14,000 or 16,000 new homes a month, that's less work for tradies. Sparkies, chippies, plumbers, less work on. That means they're going to be earning less money in the future than they were earning in the past.
That's going to then.
Well, you've already seen car sales fall off a cliff. So Mercedes reported a 43% national decline year on year in sales in Australia. Ford down 41% in November. Toyota's down. Everyone's down. But those sort of mid-bracket luxury brands, the BMWs, the Mercedes, Audis of the world, they've fallen off a cliff. So the first thing that goes when house prices fall and people are forced to focus on record levels of household debt, which is exactly what's happening, we've entered a deleveraging. Credit growth will be slower than GDP growth, then what happens is people just stop the big ticket items. Holidays will be next. You'll see declines in outbound travel. You'll see declines in expensive or luxury travel. That will start to slow down as well. You might not see a decline in cruises.
Why's that?
That's because baby boomers retire. And the first thing they want to do is travel the world on a cruise. A lot of them do. So that'll probably continue to boom. That's a demographic thing. Okay, so now that gives you a picture of why I think property prices are going to continue going down. I also think we're going to see a massive drop in construction activity in Australia. So what we know is total construction approvals or building approvals have fallen from about 280,000 dwellings a year or units a year to, when I say units, I mean units of dwelling, not necessarily apartments, to about 170,000. So that's the leading indicator for construction activity. Construction activity is still at all-time highs, right? So there's plenty of cranes out there, plenty of builders, everyone's working, everyone's busy, they're all nailing wood, they're all laying bricks, but that's peak and it is now coming off. And that's led by approvals because you can't build until you got an approval. So if approvals are coming off, dwelling construction is coming off, and that's going to have serious implications for retail trade beyond cars.
So Harvey Normans and JB Hi-Fis, etc.
So we think there's going to be a lot of opportunities over the course of the next 12 months. There'll be more downgrades from companies that are directly exposed to housing. So for example, the January retail sales numbers that came out showed that if you look at household goods, furniture and electrical, those three subcategories. If you look at those three subcategories, then what we see is that back in October, they were growing between 3.5% and 4.5% year on year. Now they're declining by 2.5%. So year on year. So they've just tipped over, and because of the data that I just mentioned a moment ago, construction activity and new house sales, that's going to fall a lot further. So the good times for value investors like us are about to happen. We're about to see it.
And so, Roger, when do you see the property market bottoming out?
Because
presumably we're not there yet. This is one of the messages.
We aren't there yet, and I'd love to be able to say to you it will be on April the 2nd, 2020 at 4:40 p.m. I can't be that precise. I have no idea when it's going to bottom. We'll have to keep an eye on all of these factors that I've just said. For example, loan demand, credit supply, all that sort of stuff is going to tell us when it bottoms. But at the moment, it's not going to bottom. The marginal buyer and seller determines the price of a property, and I've talked about that in previous videos with you, or previous interviews. And at the moment, that marginal buyer isn't really forced to sell. If they're forced to sell, then it could be a lot worse than what I'm suggesting.
And one final question. What sectors in the share market should investors be really cautious about in this sort of environment where it's a falling property market?
I'd be very reluctant to buy retail at the moment. I wouldn't want to buy car dealerships at the moment. I'd be reluctant to buy property developers at the moment. Waste disposal companies, like Bingo, for example. I don't think the worst has come yet. There was a 50% decline in the share price after they announced that they weren't going to grow profits by 15 to 20% and profits would be flat. I suspect the worst hasn't hit yet, and so it might be actually worse than that. So those sort of companies you want to avoid. The banks at this stage, their prices sort of reflect a non-recessionary outcome and a slowing of credit growth. So the banks actually look reasonably priced. They don't look expensive. but they're not bargains. And if there is a recession, I only put a 15 or 20% chance of a recession occurring. As more data comes in, we'll get a better sense of whether that's a possibility. At the moment, it is a possibility, but it's a small possibility. If there was a recession, though, the banks would fall another 30% or 40%. So they wouldn't be cheap in that scenario. But in the absence of a recession, they look like reasonable value.
Roger, fantastic. You've called this very well, and you've called it very well a long time ago, so it's playing out as planned. Thanks very much for your insights. Appreciate it.
No problem.